Welcome to WITS Business School, to the distinguished lecture by Professor Karim Abadir from Imperial College. He'll be talking about the global financial crisis and whether it's over.
Tonight, WITS Business School and the entire WITS campus are very excited to have one of the most important economic minds in the world here with us, Professor Karim Abadir. Professor Abadir is both a financial futurist and a financial realist. His research and body of work in economics has provided for deep reflection on the financial crisis of 2008. But Professor Abadir's questions tonight is the economic crisis over? I don't believe he thinks it is, and nor do I.
The work itself started early on, around the early 2000s, where he started working with his colleague on models that could help to predict patterns and trends in the economy. And they actually managed to show that the economy had entered in a recession way back in 2007, before the crisis actually started.
The causes are different from the symptoms. The things we saw, the things that were obvious to us as the symptoms of the recession were not really the causes, or were only partially the causes. Is the recovery robust? Are we really out of the woods yet? So the first time I went public with my predictions was in my inaugural talk at Imperial College in June 2007. And I gave a talk and I said explicitly, recession will happen in the United States. And if it doesn't reduce interest rates, it will be a bad one. And it will be transmitted to the rest of the world. If the US sneezes, we all catch a cold. The recoveries and the timings were also predicted. This was not based on some random predictions, because the timing was predicted. So it is based on some serious mathematical work. And it's a combination, the novelty of it was a combination of mathematics and economics. As a central banker or as a government, it takes you about half a year to a year for your policies to have an impact. I like to say that waiting to see a recession before you act is actually a sure way of inviting that recession. The real reason the crisis was so bad was an interaction, a perfect storm between the macroeconomy and the financial sector. We had a cross-section of firms throughout the major economies, in the US in particular, or in North America in particular, issuing profit warnings. So the consumer is hit by two problems, or two shocks. One is to the income, one is to the wealth. The wealth in form of housing is going to be less valuable. The origin that Paul was talking about was in number one. In number one, in 2007 already, we were seeing profit warnings from a host of companies. It's not just a specific sector, it was a cross-section, including fairly famous ones like Nortel and so on, darlings of telecom industry. Made an initial profit warning, had to lay off people, then another one until it went bust. Right, so this combination of those two factors, the macroeconomic factors and the financial factors, were creating this perfect storm that we've seen. And what I claim is that if that macro trigger initially wasn't there, that weakness in the macroeconomy wasn't there, we wouldn't have seen this kind of crisis. We would have seen a different crisis, but not this kind of crisis. The real economy would have suffered in terms of less investment spending, but on the whole, we wouldn't have had the crisis we had. The problems that I described with the financial sectors have not been fixed. The problems with central bank intervention and government intervention are not fixed yet. If you have a patient that's bleeding, you should try and stop the bleeding instead of letting it get to the coma stage. So really, the central banks were too slow to react. The European Central Bank was raising interest rates late into 2008 when already it suspected there was a recession coming. The Fed acted very well, but it acted with a delay of a year. The models that are being used in the central banks are still the same old models. So these models that predict turning points, these models that have this type of behavior that I described earlier in the lecture, are still not being used. The problem is you've got competition between banks. A good trader, if you give him that kind of compensation scheme, will walk, will go to the next bank. And that's why we need international regulation, in at least self-regulation by the banks jointly to be able to implement that kind of system. The appetite to do these things, by the way, is unfortunately gone, because at the time of the crisis, anything could have been implemented that made sense. But now, if you try to force banks into something, they would say, no thanks, why should we? Times are good. But then also the directors should be made partially liable for what they're doing. Because at the moment, the directors are given a golden parachute. After they do what they do, even if they mess up the bank, they're given some amount of money as a compensation for ending their contract early. That shouldn't be the case. The summary is that US employment has been growing in the past 4 years, whereas the European hasn't really moved in the last 4 years. Austerity is really an unnecessary imposition that shouldn't have been imposed on much of the Eurozone. Like I said, some of the Eurozone had no option, but a lot of it shouldn't have had austerity. There is another danger for Europe at the moment, which is still struggling. The bigger problem is if something happens in Far Eastern economies, the savings that are coming from China and the Far East are going to dry up. They are the ones financing the deficit in the US. So the US really needs to tackle that problem in the medium term. We are witnessing a war in Yemen that has just started. It's gone off the news because it's not as big as initially, but it has just started. The war isn't over yet. And it's very possible that it's going to cross the border into other countries, neighboring countries, could disrupt oil supplies.
You may have been predicting the timing, but did we really predict the depth, the length of the recession? We're 7 years out now and we're still feeling the effects of it, and the global extent and reach of that recession. And then I'd like to turn to what it means for the future. Are we out of it yet? Or are we really in a new normal?
One of the reasons why forecasting is so hard is that especially to forecast turning points, is that these are driven by shocks, which are hard to predict, and to have a modeling setup where one can accommodate a sequence of small perturbations that are then followed by a large shock is a massive improvement, and so is to have to accommodate for heterogeneity in agent interaction. These are all very important. My point in giving this backdrop is that perhaps one might forgive policymakers and central bankers for being timid and a little slow to act.
None of these distinguished professors were able to tell exactly when the turning point would be. And you know why? Because economics is a social science. It deals with humans. And the professor has spoken about the political aspect of it. On top of all our models sits the unpredictable, which is the political science aspect of it. The early warning signs, those small signs when they begin to occur, those are the signs that policymakers should be interested in, and not necessarily the point at which they turn. We should practice prevention. Prevention is better than cure. Do everything you can to have a balanced development and growth approach of your economy.